to thank Paul and Brandon for inviting me to speak to you this morning. I also look forward to listening as an investor the rest of the day to some of the amazing stories we're going to hear from some of the microcap companies that are going to present to us. By a show of hands, how many people here think that investing is easy? How many people here think that investing is easy? Not very many of you, which is what I thought would be the case. In fact, I would say if anybody had their hands raised, it's likely because they haven't been investing for a very long time at all. I find that the longer you invest, the more you respect what you're up against. This morning, I'd like to give you a few entertaining and illustrative examples of how hard investing can be. Here's a chart of Amazon.com from 1997. This is a 2-day chart from July 1st to July 3rd. On July 1st, Amazon was trading at a split-adjusted $1.50 per share. It was a 700 million market cap small cap company. It traded 200,000 shares that day. And I can almost guarantee you that at least one investor bought Amazon at $1.50 per share on July 1st and sold it 2 days later at $1.90 for a 24% gain in 2 days, thinking that they were a genius. And, we all know what happened next. Amazon.com over the next 2 decades would go up over 128,000%. That person or persons that would have bought Amazon on July 1st and sold it 2 days later, they didn't realize they were buying into a great business back then. You look at this chart here, and it made me think about Bernard Baruch's quote where he said, "Nobody ever lost money taking a profit." You look at this chart, I don't know about that. This is pretty painful. And I think everybody sitting in this room today has sold a stock too soon. It felt like you sold it right before the stock went up 100, 200, 500, maybe even 1,000% or more. We've all been there. It's incredibly painful. Investing is hard. On August 5th, 2015, Valeant Pharmaceuticals hit $262 per share. It was an $85 billion market cap company at the time. The stock over 500% over the previous 5 years. I'm sure someone bought Valeant that day at $262 per share, thinking they bought into a great business that could be held for decades. During this large run-up, some of the smartest investors in the world bought into Valeant. Bill Ackman and the Sequoia Fund. Sequoia Fund put about $650 million to work when the stock was around $20 per share and averaged up. And at its peak at $262 per share, the Valeant position made up 36% of the Sequoia Fund. And we know what happened next. The Sequoia Fund actually ended up averaging down at $120 per share and ultimately sold out of their position a few months later in the high 20s. And it doesn't matter your background or your pedigree. I think many people in this room have risen a stock or have held a stock the whole way up and have held it the whole way back down, and that experience can be incredibly painful. Investing is hard. On April 1st, 1976, Steve Jobs, Steve Wozniak, and Ronald Wayne founded Apple. Wayne drew up the first Apple logo. In fact, he wrote 3 men's original partnership agreement. You can see their signatures right here on this slide. And he also wrote up the first Apple I manual. Steve Jobs and Steve Wozniak each owned 45% of the company, and Ronald Wayne owned 10% of the company. 2 weeks later, he sold his 10% interest for $800. In the months that followed, Steve Jobs would beg Ronald Wayne to return, and he even offered him more equity to return, and Wayne refused. His original 10% interest would be worth $100 billion today. He was closer than anyone to the visionaries of Apple, and he still sold. A few years ago, Ronald Wayne was asked if he regretted selling his share of the company, and he said, "I made the best decision with the information available to me at the time." It doesn't matter how close you are to a story, investing is hard. In the early 1960s, cigarette consumption peaked in the United States. At this time, roughly 45% of adults in the United States smoked cigarettes. Then in 1964, the Surgeon General posted the first negative report on smoking's side effects on health. Then in 1970, they banned cigarette advertisements on TV. They then doubled the tax on cigarettes, and then they doubled the tax again. Then in 1986, the Surgeon General reported its negative findings on secondhand smoke. You know, you look at this chart here and you think to yourself, those major cigarette manufacturing companies had to have been decimated. Altria is the second largest cigarette manufacturer in the world. Last year, Morgan Housel tweeted out this comment, which I thought was brilliant. U.S. cigarette consumption has dropped 44% since 1981. Altria's stock is up 71,000% since 1981. You know, sometimes things in investing just don't make any sense. Investing is hard. Masayoshi Son is the founder of SoftBank, and he's pictured here with Bill Gates. This photo was taken in 1995, and in fact, in the mid-1990s, he was called the Japanese Bill Gates. Many people have heard of him because of SoftBank, or maybe recently because of his $100 billion vision fund, where he's deploying that capital into startups. But Masayoshi Son's story is an inspiring one, and I find that a lot of people don't know his background. Masayoshi Son was a Korean immigrant born in Tosu Saga, Japan in 1957. His family was poor. They lived in a shack. They lived in a dirt shack. They were so poor that the pigs that they owned lived in the shack with them. On top of this hardship was the fact that Masayoshi Son was a Korean immigrant, which subjected him to mistreatment and ridicule throughout his entire childhood. His escape was reading, and he would read everything that he could get his hands on. And he would just dream of the time or the day that he could get out of this shack. You know, a couple years ago, a cousin of his was interviewed, and he would retell the story that many times they would find a young Masayoshi Son as a child sitting in the corner of that dirt shack up to his waist in mud and pig feces, reading any book he could find. He focused on educating himself, and he would ultimately end up excelling in school, and at the age of 16, by himself, he would travel to the United States to take classes. A year later, he enrolled in a college. While still in college, he started 2 startup companies that he ended up selling for around $5 million. He would use that capital to go back to Japan and start SoftBank in 1981. Today, SoftBank is the 4th largest company in Japan, and Masayoshi Son is the richest person in Japan. You know, I thought I'd retell this story so you have a perspective and appreciation into his background, and also maybe it would give you a perspective on why he seems so fearless today. You know, when you persevere through hell as a child, you aren't afraid of anything. You know, in the mid-1990s, Masayoshi Son set up SoftBank Technology Ventures, and this was a predecessor to the Vision Fund, and he invested heavily in internet companies in the mid-1990s. Over a 3-year period, he invested over $2 billion across 100 internet companies. It was estimated that at the internet bubble's peak in the year 2000, that SoftBank owned roughly 10% of the entire publicly traded value of all internet companies. But when the technology bubble burst in 2001, SoftBank lost 99% of its value from its peak. Masayoshi Son himself lost more money than any other person in history. His net worth declined from $76 billion to $1 billion in 3 years. But a couple years prior to this, he made a very, very important investment. In 1999, Masayoshi Son and SoftBank made a $20 million investment into Alibaba. This investment is considered today to be the most successful investment ever in the history of mankind. SoftBank's $20 million investment is worth $120 billion today. This is a 6,500x return. What's interesting about this is Masayoshi Son made over 100 investments. He almost went bankrupt, but a few investments saved him. Investing is hard. Now that I think I have most of your attention, I hope that most of you are awake, I thought I'd get you to participate a bit in this next example. And The example I'm going to give next is a real example. The financials I'm going to show you are real. The scenario I'm going to set up for you is also real. Here are revenue, net income, and growth metrics for a company from Q3 2003 to Q2 2004. The information for each quarter, kind of runs horizontally. If you look at the bottom row at Q2 2004, across the top column, you see the trailing 12-month revenue, trailing net income, trailing quarter-over-quarter revenue growth, year-over-year net income growth. Again, this is a real example. These are the real numbers. During this time period, this company here is a microcap company. It created its niche and its category. As you can see, revenue and net income, it looks like the growth is continuing to accelerate. Now, I could also give you the balance sheet. I could also give you the cash flow statement, which are obviously very important. But for the sake of time, let's just say that they are what you would expect and there are no red flags. So given what you see here, by a show of hands, how many people would be interested in owning this company? Okay, quite a few. Now, it's probably actually a hard question to answer because I didn't tell you what the valuation of this company is. So let's just say that this company is trading at a 10 PE. How many people here would own this company at a 10 PE? Come on, everybody's hands here should be raised. Paul obviously hasn't taught you anything here, if they aren't. Okay, now how many people would own this at a 20 PE? How many would own this at a 30 PE? Okay, we still have quite a few hands raised. What if I told you, and this is a real story, so what I'm telling you is real, that during Q2 2004, so the last period shown here on this slide, what if I told you that the two largest industry players, one's an 80 billion market cap company, one's a 110 billion market cap company, took notice of the category that this small company created and decided to launch their own products into the market? Both of these behemoths have global distribution systems, and they intend to spend tens of millions of dollars in marketing to take market share. So given this new information, how many of you would still own this company? Okay, quite a few less. Now, what if I told you, and this is real, that at the same time that these two industry behemoths announced plans to enter the market, that the CEO and the COO of this small company sold 26% of their holdings? So, just in review, we have a company that's a microcap. It's growing revenues 40% per year. Net income is growing 267% year over year. The growth looks to be accelerating. The company is trading at a 30 PE. Two of the industry's largest competitors have taken notice and are entering the market. The CEO and the COO just sold a quarter of their position. How many of you would own this company? I don't know if I would. And, by the judge of it, not many of you would as well. Well, you would have missed out on a 140 bagger because this company is Monster Beverage. We actually wrote a whole case study on Monster Beverage on intelligentfanatics.com. In the case study, we take you through the entire history of the company from a stock valuation and competitive situation. Reading through the history of Monster Beverage just reinforces how hard investing can be. Investing is hard for a variety of reasons. Some of the reasons are outside our control, but many of them are totally within our control. Oftentimes, it's our human nature that gets us into trouble. Successful investing is counterintuitive to our human nature. It's a lifelong process of retraining our minds to think different and better. I've been investing now for close to 20 years. I've been a full-time private investor, exclusively investing in microcaps for a little over 10 years. I feel I've been lucky because I'm old enough to have emotionally invested through two bear markets, but I'm still young enough to hopefully benefit from those lessons that I've learned. And I'd like to share a few of those lessons with you this morning. When you were trying to find great businesses early, intelligent fanatics early, before the inflection point, before it's obvious in the financials, there are a lot of moving parts. These companies are small and evolving. There's a lot of imperfect information that you're collecting. You aren't going to be right all the time, and you need to accept this. We often read quotes like this one from Peter Lynch, where he says, in this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. I think we oftentimes read this and we nod our heads in affirmation, but deep down we think we can be right all the time. We think that the search for perfection makes us better. Well, I don't think it necessarily does. When you're investing in small microcap companies around an inflection point, you're simply looking for signs of greatness. The businesses might evolve the way you think, or they might not evolve at all. It's not batting average that is important. It's slugging percentage. Your success or failure as a microcap investor will be decided by how quickly you cut your losers and how fast you lean in and own more of your winners. When I was younger, I would immediately take large positions. If I liked something, I'd go all in right away. I was fearless. And this strategy works until it doesn't. I got lucky a little bit in my early years because it worked a few times in a row. But what I found out is you don't need to bet the farm right away. You have time. That's the great thing about microcaps. There's a long way to go to the upside if management continues to execute. So let management prove themselves to you before you own more. Let me ask you a question. How many companies have you owned where you genuinely like them more 1, 2, 3 years later? How many companies have you owned where you genuinely like them more a few years later? I think if we're all being honest with ourselves, the answer to that is not very many. And I think that's just proof that you need to weight your position sizing in the beginning accordingly. I like to buy about a third of my position in the beginning, then I buy more as management executes. The best ones are the companies I'm continuously averaging up in. I think one of the most misused quotes of Warren Buffett is our favorite holding period is forever. He didn't mean that every stock should be held forever. He certainly wasn't talking about most microcaps. Holding forever only works when management executes forever. And so my holding philosophy is quite simple. I hold as long as management executes. And to do so, you need to understand the businesses you invest in on almost a personal level. I find that too many investors stay trapped to their offices and strapped to their chairs evaluating businesses on Excel spreadsheets. Businesses are not Excel spreadsheets. Businesses are people. Let me give you sort of a due diligence hack. 95% of due diligence is analyzing if customers and employees are happy and why. Your edge is that 95% of investors will not do this. If you want above average returns, you need to do what average investors aren't willing to do. Due diligence doesn't end after you buy your shares or you make your initial investment. Buy and hold isn't buy and forget. You need to buy and verify your thesis, and the smaller the company, the more often you verify. The only thing more important than having a great investment thesis is knowing what will kill your investment thesis and having the decisiveness to act. Write down a list of what will kill your thesis. This might sound counterintuitive, but if you are truly prepared, then you should be prepared to be wrong. What I do with every position is try to develop contact points through my scuttlebutt research to gauge industry and company optics and data points. For example, I like to have at least 5 points of contact to represent customers, maybe suppliers, and in other areas as well. I also set up multiple keywords in Google Alerts and in other places. You want to cast a wide but strategic net. All of this might sound quite excessive, what I'm describing, but I'm still a full-time investor today, not because of my gains, but because of the losses I didn't take. One of the biggest mistakes investors make is selling their winners and buying more of their losers. If anything, you should be doing the opposite of that. Unfortunately, but over the last 20 years, history has taught me that visionary leadership that executes is rare. Always own more of the management teams that have shown a history of executing. I know Paul also likes this quote here, and this is a quote from Bill O'Neill. Take your losses quickly and your profits slowly, because your objective is not just to be right, but to make big money when you are right. The final point I'd like to make this morning is do the work. Don't bother finding the next multi-bagger if you aren't going to develop the conviction to hold it. You can borrow someone else's stock ideas, but you can't borrow their conviction. True conviction can only be obtained by trusting your own research over that of others. And I think Paul and Brandon here today would agree with this. Their job is to show you ideas and why they like them. They aren't going to be right all the time. It's your job to put in the work and decide for yourself what to do. When you blame others for your investing mistakes, it proves you didn't do enough of your own work. So in conclusion, investing is hard, but it's also a whole lot of fun. You only have to find a few great investments early to beat the market and to change your life. Do the work, wait for your pitch, and swig hard. Thank you.